Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menasce. On today's show, we're talking about a new report from commercial brokerage house CBRE on the state of cap rates across the United States. It comes as no surprise that cap rates have been compressing. Everyone knows there's too much money in the system chasing yield. For those who forgot the definition of cap rate, we're talking about a measure of profit margin that's calculated by taking the annual net operating income before debt service and dividing that by the total investment in the project. It's a measure of unlevered investment yield. The lower the cap rate, the more expensive the project. This comprehensive study by CBRE looks at the average cap rate and investment trends across a number of primary markets in the U.S. for the second half of 2021. Note that this report does not take into account any market influence resulting from Russia's invasion of the Ukraine. In terms of sales volume, average commercial sales have hovered around $100 billion a quarter over the past several years. But sales numbers were up across the board in the second half of the year, and in Q4, they peaked at over $300 billion in transactions for the quarter. The multifamily sector saw the biggest increase, accounting for nearly half of all sales volume in 2021. Spreads between cap rates and bond yields have historically been a strong driver of both investment flows into property markets and resulting in cap rate compression. In 2020, some of the aggressive monetary stimulus from the Federal Reserve caused cap rates to decline noticeably, including through 2021, and strong investor demand for both industrial and multifamily assets also led to falling cap rates. There's just too much money chasing too few projects. Looking forward to 2022, CBRE expects the 10-year Treasury to increase to a 2.3% yield, a level that will maintain a healthy spread relative to real estate market cap rates. Property market fundamentals, which are driving returns, will be underpinned by strong economic growth. So they anticipate that investors are going to continue to look for real estate for both relatively attractive returns and as a hedge against inflation. There's a clear geographic pattern emerging with regards to multifamily cap rate compression. High-growth Sunbelt markets saw the greatest increases in price or the greatest declines in cap rate relative to historic levels, and they're poised for stronger rent growth. Cities that were showing cap rates averaging 4.5% are now selling at a 3% cap rate. That's mind-boggling to me. This includes cities like Dallas, Austin, Phoenix, Nashville, and Denver. Other up-and-coming cities like Charlotte, Raleigh, Orlando, and Atlanta are pricing at a 3.25% cap rate in the second half of 2021. These prices can only be justified if you take a forward-looking view of rents and assume continued rent growth, which would be added to the NOI and thereby reduce the yield on cost to a more reasonable number. When asked whether survey respondents felt that pricing for quality multifamily projects was converging between some of the secondary markets and the gateway cities, 85% said yes. So some of those secondary markets that have traditionally lagged the gateway cities are now starting to approach gateway city valuations. In industrial assets, we're also seeing significant price increases. Here too, the lower cap rates are a reflection of forecast rent growth over the next couple of years. In areas where rent growth is estimated at 4% per year, cap rates are hovering around 3.75%. For properties with a projection of 8% rent growth over the next 2 years, the cap rates are now pushing 2.5%. Again, this cap rate only makes sense if those rent increases really come to fruition. To my eye, this cap rate makes these assets look extremely overpriced. There's always some risk on rent increase. The start-stop nature of economic activity over the past 2 years has most respondents believing the general macro uncertainty is the greatest risk factor. Specifically, office respondents rated this as the highest risk, whereas multifamily respondents were much less concerned about. Even through the pandemic, multifamily asset owners have experienced pretty good stability throughout a period of otherwise uncertainty. When you look forward in a rising interest rate environment, the theory is that homeownership becomes less affordable and therefore demand for rental accommodations is going to continue to be very strong. The second greatest concern is an acceleration of more aggressive interest rate hikes. That's a concern specifically in the leveraged multifamily space. All of these market conditions are clearly indicative of too much money chasing yield. It's further validation of our strategy of focusing on new development. We find that we can build new product for less than the equivalent finished product is trading for in the open market. And this is true even with the supply chain disruptions and material cost increases. Now, we've sold more assets in the past 6 months, selling into these aggressive market conditions than at any time in recent memory. We're still acquiring selectively, but we've not lowered our standards for acquisitions, despite the increasing prices. These market conditions represent elevated risk in our opinion. If you simply read the CBRE report at face value, you might conclude that everything is sunshine and unicorns, and we don't view it that way. We see the market conditions as having downside risk and very little upside potential. I have a hard time believing that 3% cap rates make any sense in a rising interest rate environment. I suspect we're going to look back on the second half of 2021 and shake our heads at the irrational exuberance of those valuations. For those looking to exit, it might be a good time, but I would certainly not recommend buying at those cap rates even if the market is telling you this is the new normal. There are additional asset classes covered in the report which I've not spoken about today. For more information, you can get the full report from the research department at CBRE on their website. They also publish additional reports that are more geographically specific that are worth a few minutes of your time perusing. As you think about that, have an awesome rest of your day. Go make some great things happen. We'll talk to you again tomorrow.